good afternoon, and welcome to PSE's free webinar on Real Estate Investment Trust, or REIT. Please note that the following presentation is for educational and informational purposes only and should not be construed as a professional, financial, and investment advice or recommendation from the PSE. Our speaker is the Managing Director and Head of Equity Capital Markets Team of Investment and Capital Corporation of the Philippines, or ICCP. Prior to holding this position, he was the Director for Corporate Finance at Abacus Capital and Investment Corporation and held previous postings at ICCP, City Trust Banking Corporation, and Union Bank of the Philippines. He has over 30 years' experience in investment banking and specializes in equity capital market transactions, particularly in public and private equity offerings. Ladies and gentlemen, let us all welcome Mr. Manny Ocampo.
Good afternoon, ladies and gentlemen, and welcome to this afternoon's.
The broadcast is now starting. All attendees are in listen-only mode.
This webinar. Just to give you a background, I was invited a few weeks ago by the PSE to do an orientation presentation on REITs to the trading participants. So I'm pretty much doing essentially the same presentation to you guys out there. Welcome, and hope you're able to pick up a few things about REITs this afternoon. So let me go to the table of contents. So I'll be covering in the first section an overview about REITs, and then the benefit of the REIT platform to investors and sponsors. We also will give you a background of how investment banks will go about pricing or benchmarking REITs. No, I'll also give you a discussion about key considerations when you are launching REITs, or from the issuer's point of view, and also from the investor's point of view. What should you be looking out for on REIT offerings coming to the market? Now, because we don't have any REITs yet in the Philippines, I'll come around and discuss a case study about Capital Land in Singapore. Singapore being, I guess, one of the biggest market for real estate investment trusts in Asia, outside of Japan. So going into my presentation on REIT overview. First of all, let me say that the REITs, was really came about from Republic Act 9856, or the REIT Act of 2019. So we're just coming out with the REITs now, given the new implementing rules and regulations, and we hope to be able to launch market conditions willing, launch a REIT sooner than later, like hopefully within the first half of the year. Now, in the Philippines, a REIT is organized really as a stock corporation, pretty much what you would see among companies listed in the PSE. So nothing different there. It's you're buying shares of stock of the corporation. Elsewhere, for example, in Singapore, you buy trust units. So that is how REITs are organized, as trust units, or special purpose vehicles. Now, the features of a REIT. It's essentially a hybrid product. It's an equity product that has a defined yield and capital gains potential. Now, defined yield is really because of regulatory considerations in the forming a REIT, where they are required to pay out as dividends 90% of their distributable income. So as a REIT investor, you will expect to receive a decent amount of cash dividends on a regular basis from a REIT. Now, unlike preferred shares that has a defined percentage, REITs will not have a fixed percentage, of dividends. But it will really depend on the income that they generate. It's just that 90% of the income by law they are required to give it to their investors. No, the potential for capital gains, on the other hand, comes about because the REITs, while they own the land and buildings that are that are folded into the REIT company, uh, the REIT is able or will have the capability to sell and recognize capital gains on its actual asset holdings. Investors also gain a direct participation in income generating real estate properties. So unlike investing in property companies, you are invested in, say, Uptown Mall, an Uptown Mall REIT, one of the BPO buildings of Ayala Land along, along De La Rosa Street or something like that. So the asset that you own is you have a direct play in that particular asset, and that is quite defined. It's only that asset. You're not invested in Ayala Corp or Ayala Land, which has a few hundred different projects going on, no? But you're invested in particular projects that are specified in that REIT. Now, usually, a REIT will be comprised of a pool of properties. So you have diversification right away in that pool. You also have income profile diversification, because your cash flows will come from various lease contracts that have essentially staggered expiry profiles. And these are pretty much to different end users or lessees. No, so that's quite, you're invested in a diversified portfolio right away. REITs also, because companies that form REITs are presumed to have assets that have stable and mature revenues about them already. So it's something that you can count in year in and year out. You also by law have a definite distribution policy. By law, REITs are required to distribute at least 90% of their distributable income as a minimum. So a REIT can pay as much as 100% of their distributable income. And I'll go later on why, for sponsors, it actually may make sense to pay out as much of their distributable income as dividends. No, I'll discuss that later on. And there's a tax angle on that one. REITs by nature also are by law required to be listed in the stock exchange. So there is liquidity. The shares that you own in a REIT company will be listed and traded as regular equity instruments listed in the stock market. The REIT itself will technically not have any employees except for the board of directors. And the composition of that will mostly be independent directors, or a good portion of that will be independent directors. No, now the REITs, on the other hand, are managed through what are called management entities, which are the fund management and property management firms. No, the fund managers take care of finances, etc., of the REIT company, while the property managers take care of the operational aspect of the properties in the REIT. So they take care of facilities management, leasing of available properties or spaces in the REIT, or the asset. I just want to give you maybe a background on what the REIT profile looks like in our side of the world, Asia, ASEAN. So in Singapore, which has the biggest number of REITs listed, market cap before all hell broke loose with the virus, no, and I'll have to say it that way, was at essentially almost 80 billion US dollars. Hong Kong was at almost 34 billion dollars, having 12 REITs in there. Sorry, let me go back. Singapore had up to now has 43 REITs listed. Thailand has 58 REITs and property fund companies listed with a market cap of almost 12 billion. So you have a number of smaller REIT companies listed in Thailand. Malaysia, same way, they have about 10.5 billion in market cap among 18 REITs. Indonesia, probably just came into market last year. They have one REIT listed. Philippines, this 2020, we hope to have at least one, two, three or so REITs listed now. We actually know of a number of firms getting ready. I guess when market conditions and regulatory vetting is done with these applicants, we'll probably see a first REIT coming out within the first half of the year. Just to give you an idea of what returns REIT give in relation to listed stocks. Generally, they would tend to return higher. The returns would be higher for yield for REITs because again there is that capital gain potential, and there is also the fixed dividends that they get from the from the leases that are inherent in the REITs. No, so just to say that, for example, if you look at the slide, Singapore has an 18% one-year return. U.S. listed REITs on the other hand have a 24% return. Now, again, let me say that before market volatility from the coronavirus happened, we actually were looking at a very positive background on why REITs are expected to take off in the Philippines. Number one, the country, well, even with the virus issue now, which eventually will run out on its own, faces a positive economic outlook driven by strong fundamentals. Metro Manila's real estate investment and development prospects remain favorable compared to other emerging economies in the region. Market values have been growing at a robust pace, and I guess this also gives a lot of confidence in coming out with more assets or more properties at this time. Among the major property developers like Ayala Land, Mega World, even Double Dragon, we see a sustainable inventory of prime, mature, and good quality commercial properties that are in fact REITable or can be put into a REIT. No? Now, the shall we say the leasing, the end market demand is really driven by the growth and continued growth in the offshoring and outsourcing sectors driving demand. We also see developers, property developers, looking for other funding sources to finance new projects, and REITs really provide the property developers or what we call REIT sponsors with a new funding source to launch new projects that they have. So REITs by themselves really represent a new asset class, and they're not common shares where it's all pretty much capital gains. They are not preferred shares, on the other hand, where it's all yield or by dividend yield specified by their dividend rate. No, so it's something in between, and I think market participants and investors are looking for such an instrument to come out. No, so this is a slide just to show the interconnection or interplay of various entities involved in a REIT. On the upper right-hand corner, you really have the sponsor or promoter, which is the, shall we say, the property development company that would put in its holdings of properties into the REIT company, the one in the center. No, your fund manager and your property manager are the ones providing management services to the REIT. Now, the REIT, when they are listed in the stock exchange, what happens there is that the offering, which is what the investing public puts in, funds of the offering go back to the REIT sponsor or the REIT company if they do a primary offer. So I guess one of the things you've read in the papers also about REIT is that REITs are required to have a reinvestment plan. So this is a requirement on the sponsor or promoter, where they should put back or reinvest the proceeds they have in Philippine property projects. No, so again, that should continue to promote growth and activity in the property sector. Now, looking at the benefits of the REIT platform, let me just go to investors. You really have a participation in a new asset class, and the requirement of law on REITs, no, to distribute 90% of their income as dividends to investors. Investors get an assurance of current cash flow returns as well as yield. And I'll go later on what to expect, at least in the developed REIT markets, what kind of premiums over risk-free rates REITs are able to provide investors. No? There is also an opportunity to investors to have direct ownership in income-producing real estate properties. No? And these properties represent a diversified portfolio. It's just, again, a REIT will be composed of several assets. I don't think you'll see just one, say, office building or one mall in a REIT. You'll probably see several, maybe even a mix of office, retail, and maybe even hospitality properties within a REIT. No? So you have a diversified portfolio right away. Now, to the sponsors, the benefit to them is really access to capital, and they also have tax and liquidity benefits from the REIT offer. No? Now, okay, I'll go into this. What I said earlier, when the REIT, no, when the REIT issues dividends under the law, these dividends are actually tax deductible expenses from the point of view of the REIT company. So that if you kick out, say, 100% of your income as dividends, that's all essentially tax deductible from the point of view of the REIT. So the REIT essentially can reduce its taxes significantly, and that's the benefit given to the REIT. No, it's if you'd like a concession given to the REIT. So issuers or sponsors can actually afford to be generous on giving out dividends, and this is something we've seen in, for example, developed markets of REITs in Singapore. You see yields at significant premiums over risk-free rates. No. Now, to sponsors, there is also marketing. They're provided with marketing advantages and a seal of good housekeeping on their different properties. They are also able to recycle capital without loss of control. No, again, at the end of the day, for REITs, they are required to offer at least 33%. The sponsor or the property company still owns a majority or a controlling stake in the REIT. No? So they're able to consolidate the REIT company into their into the parent company balance sheet. So and because of the tax advantages, it makes sense for them to kick out dividends, because the dividends they receive anyway, and they're able to get the tax benefit of the deduction of the dividends as expense taxable on their expenses. Just on pricing and benchmarking, I just like to give you a presentation on the snapshot of yields of various investment products in the Philippines and REITs in Singapore. No, on the left hand side, you'll see that real estate company average yields, for example, the first bar there, worth about 1.3%. Utilities provided a dividend yield of closer to 4%. The PSEs, companies listed in the PSE, provided an average yield of about 1.8%. No, now you'll note that Philippines 10-year government bonds, on the other hand, give a yield of 4.7%. So your risk-free rate in the Philippines actually was higher than the dividend yields of the different property companies, utilities, or even the PSE in general. Looking to the right-hand side of the group, you'll see here what the different REITs in Singapore were offering by way of dividend yields. No, the extreme right-hand bar, which is the SG 10-year government bond yield of only 1.6%. So you see there, overall Singapore REITs have an average yield of 5.5, 5.6, 5%, 5.2, etc. On the average, REITs in Singapore provided an almost 400 basis point spread over the risk-free rate. No, so again, it seems very rich, and it seems very interesting, and that's really one of the reasons why the REIT market in Singapore has grown in the proportion and numbers that we see it to be, because property developers were quite generous to share the dividends with prospective shareholders. And again, the advantage to them is more a tax advantage. Whatever they give out by way of dividends come back to them in terms of tax savings, and dividend yield also going to them. So again, just to emphasize further the benchmarks for REITs against risk-free rates. Okay, so this is a chart, and we'll see where our gaps are for the Philippines. What property companies are giving by way of dividend yield. So you see that property companies have not been giving the returns. No, so people invest more in bonds rather than in property companies. No, but with REITs that should change, and we should see a positive return over risk-free rate happening. No? So maybe I'll give you since we are an underwriter, will explain to you or give you at least an idea of the process that we will go through with the REIT. With the REIT sponsor on how we would price their particular issue. Usually what we do is have an early look. So we would take a look at the assets that they would put in the REIT which is important. What kind of lease revenues these assets generate, and our simulation, we would run simulations with them on what kind of potential yield these would provide prospective investors, given the value of the properties that they have, and the potentials and the upside potentials of these assets. No? Now, as we go along the way, once we have the initial formation of what the REIT would look like and what the prospective yields would look like, we would maybe shop it around already and talk to cornerstone investors. So these are investors that would take fairly big chunks of the offer, really to provide a base of demand for the REIT. No? So we're testing with big institutional investors, people that will likely stay on with the company for some time. So it's a stable group. If they like the assets underneath, they see the potentials for capital gains in over the next few years, and they'll really take maybe a 5-10 year view of the REIT company in this respect. No. So those are the investors. So these are called the cornerstone investors. Will take a check and maybe take demand, get demand or orders from these groups. On stage 3, we would go into investor education. So we would be now meeting with what are called qualified institutional buyers. So these are, again, people like SSS, GSIS, insurance companies, the trust funds of most of the banks, taking a look at their yields and maybe giving them the storyline of what the REIT will look like. Again, the objective there is to generate interest, generate orders, which leads us now to the management roadshow. This is usually to the general public. I'm sure most of you have attended the company roadshows of companies going IPO. So at this point in time, there's a good chance that maybe most of the shares of the offer have been committed or have firm orders behind them already, and the underwriters and the issuer would really be looking to generate maybe a wider interest among the investing public. At that point in time, we would then move into the pricing and allocation. So following the requirements of the PSE also and the SEC, we would be allotting an allocation to local small investors for REITs. So we're treated like an IPO. So the LSI and I guess through PSEC, you would be able to give your orders for the REITs. So in pricing and allocation, the objective really of the underwriter and the issuer would be to maximize maximize size rather, optimize price. So we will come up with a price that leaves a lot of potential return, for prospective investors, and hopefully drive bigger demand so that there's buying demand into the when we get it listed. At the end of the day, I think what we want to happen here is that we're able to price the REIT at a level where even just investing in it and sitting on it for the current yields or dividend yields is something that investors will be happy with. so that we probably will price at above your risk-free rate, whatever, we're right now, I think 10-year rates are at about 4.25%. Now, it's actually gone down with the rate cuts done by the government, but so we should be at a decent premium over that. So again, just a diagram of pricing and the allocation strategy. So just maybe this one is take this as a guide when you're looking at REITs, what to look for, and what to maybe things to avoid also. So looking at the REITs, you would look at the asset fundamentals, no? How many percent of the asset is owned by the project sponsor or the REIT company? The asset life, for example, is it a new building? Is it a 3-year-old building, a 5-year-old building, or a 20, 30-year-old building? The location, is it within the central business district? Is it outside? So things like that you'll want to take a look at, and you'll want to see the demand profile for such a property. You then take a look at the revenue streams of the REIT, leases that it has, and this will be disclosed. Are they fixed or variable lease provisions? Are they long or short-term lease contracts? Do they have adjustments for inflation or escalation? Stuff like that, no? Sorry. And then we also will look at the costs of the asset. What are operating and management costs looking like? Will there be additional capital expenditures that need to be undertaken in the future? So we would also look at the operational track record and stability of the asset. So is it a mature asset with that has achieved stable cash flows? Customers of the end users in the different properties. So we would give you a profile, and I think it's good to know the profile of the lessees of that particular building or mall, for example. No. Now, what are unsuitable assets? Well, number one, assets that were just recently developed, because there's a lot of uncertainty at this point in time. So you don't want to be committed into that kind of a situation where you're not sure if the vacancy will actually be sold out, and how soon that asset gets sold out. No. Properties recently acquired from third parties would be another thing we would be watching out against for. Assets that also may have significant enhancement plans or requirements in the near future. As I mentioned, if you're looking at a 30, 40-year-old asset, while it may be in the central of the CBD, at some point in time, it may require major renovation and refurbishing costs, and expenses. On the asset control, let me just say that the asset and land should preferably be owned by the sponsor or the REIT. The reason for this is the land ownership is where the capital gains really come in for the investors. The building over time depreciates, etc., loses value, but the land underneath it, will be the one appreciating over time, especially if you're located in a central business district. Minority control assets, or assets that are not really controlled, or shall we say only minority controlled by the REIT, are something we would avoid. The REIT's ability to declare and repatriate dividends. if the REIT has outstanding loans, are there negative covenants, for example, that may restrict the ability of the REIT to pay out dividends? And then the stability of political, legal, and regulatory jurisdictions where the assets are located. Are the local government units going to be raising property taxes, business taxes, etc.? So one of those things we would have to take a look at. So again, what are the considerations we look at in the valuation? We would look at the historical and forecast operating performance, the book value, and indicative valuation, revenue to asset value, or what we call the cap rate of the asset. No, so the higher the cap rate, the better. Restrictions also, any legal or regulatory restrictions on the asset, diversification. Is it all, you may have a situation where a whole, shall we say, office building is leased out to just one BPO. So while the BPO may have a good name, you, on the other hand, are very dependent on that particular BPO. So you don't want to be invested in a REIT that has that is concentrated, shall we say, with only one customer. And then the management. So one would have to take a look at the track record of the property managers and the fund managers of the REIT company as well. So just to conclude, the formation of a REIT to be successful, we look at high quality assets in the REIT. Future potentials for growth are something we would look at, and then the valuation of the assets to be injected into the REIT. Now, this is where the play comes in as far as yields to investors come in. Is the sponsor folding in the REIT at maxed out valuations, or are they providing a discount to its book value or adjusted book value? And then you'll see what the potential returns look like in that respect. So those are things to look out for. And I guess end of the day, you would be looking at yields and the potential for capital gains. So again, the valuation, and then the competency and capability, of course, of your fund and property managers are things that you would look at. Do they have track record in, for example, redeploying vacant spaces in a building? Can they market that readily? So that's what you want to take a look at. Now, timing, save for maybe the current uncertainty because of the coronavirus, but that aside, we are actually facing a situation where interest rates are at historically low levels, and we do not see interest rates globally, in fact, moving up in a significant bounce up. In fact, if you see the trend right now, you have central banks cutting policy rates, and that is something that actually makes it quite attractive to launch a REIT offering at this point in time, because your alternative is to take a look at what, for example, Philippine 10-year government bonds at 4.5%, and directionally you see the government cutting rates further, so that will probably go down further. So that is, and REITs, hopefully, issuers or sponsors become responsive and make it attractive for investors to get in, and would price it, hopefully comparable premiums like what you have in the Singapore REIT market. Now, just to conclude, maybe, this is more a situation or a case for Capital Land, and let me reverse things a little bit, because this is where you take a look at the property company, listed property company, shall we say, that launches a REIT. No, as property companies, Capital Land, which is I guess the comparable would be something like an Ayala Land in here in the Philippines. Capital Land had various assets in malls, commercial buildings, even residences and hospitality, as well as assets outside the Philippines. No, so they formed they formed their various asset holdings into REITs and launched them one by one through the years. And you have there the yields and the offer sizes that they came out at in various times. But what is of interest is that what's the impact of launching REITs for Capital Land? No, so they successfully lightened up their Capital Land successfully lightened up their balance sheet by selling assets through REITs, and that has really yielded positive returns by way of improved returns on equity and returns on asset, as well as the impact on market cap of Capital Land. So it's actually with this we actually see it quite positive for the REIT sponsor, no, to have launched its various asset holdings as REITs. So that, ladies and gentlemen, concludes my presentation. Thank you very much for listening in.